The last thing I want to talk about before we start talking about risk management, all the boring stuff I know, is the choosing contracts and understanding pretty much any like if you're taking like a signal or something, it's not financial advice, but you should do your own discretion, your own research, right? If you're taking trades from other people, make sure that it's not a pump and dump. That is the most common and obnoxious type of people in the world is pump and dumpers. So be careful. If you're seeing someone send out a trade for PG and it's like $4 a contract, there you go. There's nothing else to say, right? That's an obvious pump and dump. But anyways, let's say hood, right? We like hood. We open in above 48.79 and we're gonna go buy a contract for a breakout we just saw, right? So we're breaking past this daily level, 49.88. We go in our smaller time frame and we get a full close above this level right here. We feel comfortable taking this trade. Now, when we go to buy the contract on our broker, well, what do we do, right? Like, what am I looking for? There's so many strikes, and by strikes, I mean those little things you see that have like that number next to it, and then your date and all these random things. It's extremely confusing, right? But it's not. It doesn't have to be, right? So pretty much what you're looking for here, I guess this will make more sense if it was replicating this, but you're gonna see all these numbers here, right? Every single number on the side. Oops, if I can even bring up this over here. You're gonna see all of these numbers on this side, on this column. And you're gonna see 54, 53, 52, 51, and you're gonna be buying obviously calls because if you think the stock is gonna go up, well then you buy calls. Now, if you were to think that the stock is gonna go down, like down, 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 then you would be buying puts, right? So in this case, we would be buying calls. We're probably seeing like 51 here, 52, 53, 53.5, maybe 54. And you might think, okay, well, that's a lot of information. What am I going to do, right? How do I buy a contract? What am I looking for? It's extremely simple. What I personally like doing is buying the strike for the price target. Now, rule of thumb is to make sure that the contract that you're buying isn't as cheap as it seems. Like it shouldn't be like $10 a contract. Let's say a strike price for 52 calls or like 0.50 a contract. That's really good, right? It's not bad. 53 is maybe 0.30, or actually that wouldn't make sense. Let's say like 0.25 because the example I'm trying to make here is that 54 calls or 55 would be like 0.11, right? Okay, so we have this in mind. We want to be buying closer towards the 54.84 level. So if we're buying in round numbers, that would be the 55 calls, right? Because 54.84 is closer to 55. You do not need to make as much analysis I'm doing right now. I'm sorry if it sounds like it's overwhelming. It's not. You're just looking at the level. What's it closest to? 55, right? Okay, so we're buying 55 calls. But in this case, 55 calls, this happens very rarely, but if that's the case that you see 55 calls or $11 a contract, I would personally buy maybe 54 calls where they are, let's say, 18 a contract at least, right? Because it's closer to your price target, but it's not far, far away to the point where it's like $10 a trade, right? The only problem that you have when it's $11 or $8 a trade is that you're going to be moving in intervals of one, and those intervals of one, let's say from $11 to $12, is going to make a very huge difference in your contract price. So if it goes from 11 to 13, you might be moving 20%, 30%. And sure, it sounds nice, but it's going to take a lot more for it to go from 11 to 13 a contract because it needs a bigger move since your strike is further away. The further the strike is, the closer it gets, the more it will move, right? But if it's not moving down here and it's stuck down here, it's not going to really move the premium, especially if it's far away. So if it's $11 and it goes from 11 to 9 instantly on a pullback, the trade is already over. You're down 30% and then you're already starting to panic. So if you're buying closer, maybe 53 calls, for example, $25 a contract, extremely nice because it moves 26, 27, 28, and it moves faster, it moves nicer. You're not worried about taking so long to move from 11 to 12 or getting that 13 fill, right? You could maybe get 28 fill or 29 or lower your ask to 28. I know it sounds crazy. You don't have to think about it too much, but just try to buy somewhere above the 15s minimum. Somewhere like 18, 20s, 30s is fine. If you want to buy $100 contracts, that's also fine. The only thing you want to keep in mind when you're trading is to buy the price target as long as it's not too cheap. So, for example, we go and buy AMD calls. Our next price target here is realistically 116.55, right? So we're at 114.90. That is maybe like 2 strikes out the money. That's perfect. It works. It's nothing crazy. Maybe it's like $30 a contract and 117 calls or 25 a contract. You can even go as far as buying the 117 calls because it's not cheap. It's not crazy far away. It's only the 1.89% move. And for AMD, it's realistic, right? It moves 5% a day, 2% a day, 2% a day. And by the way, I'm holding shift and left click to bring this up if you want to do this as well. So it's not unrealistic to go to 117 in one day and you can buy that strike. So 117 or 116 calls, perfect, right? Don't think about it too much, right? Like you don't need to understand the logic behind the contracts. You just keep in mind, what you're looking at. The only thing that also I want to talk about for strikes and contracts is to make sure that you don't see something like this when you go buy the contracts. And if you do see something like this and you're very, very, what's it called, stuck in that trade, like the idea that it's going to work out, then size down because it's going to be extremely crazy to be in that trade. So what I mean by that is you can take it as a lotto size, maybe a lotto ticket. Think of it as that, right? You don't want to be in full size because if you're in full size on a trade like this, you're buying a spread like this, $140 and $60, you're going to lose instantly minimum $60 a second you enter this trade. Minimum. And a rule of thumb for trading things like this is if you're going to buy this really badly, like you're stuck on this trade, is go for the mid price at least. Go and buy this because you're not losing $60 a contract. $60 the second you enter that trade, you're losing only $30. And it's still really bad because, mind you, SPY spread, and spread by, what I mean by spread is that, like the bid and the ask. So the ask and the bid, the spread in between these two is a $60 difference, as you can see, right? So keep in mind, SPY spread is $2 max. Usually it's only $1. Just put that in mind why I say this is extremely risky to be getting into trades like this. Some of these trades, there are, like, I've sent lottos that are in the past, but only because they have guaranteed momentum. And sometimes I'm wrong about it, which is why it loses really quickly its value. But if I'm right about it, it can go from $80 bid to like $200 bid, and the contracts go from like 0% to 200% in seconds, which is crazy. And sometimes if they trend, they go 2000% easily. But the point I'm trying to make here is keep in mind, if you're trying to take regular trades and not risk anything, you should avoid trades like this because the second you enter something like this, you're gonna lose instantly $60. Again, I'm gonna have a thread under this video if you want to go look into it a bit more. I spent like so long, like hours writing this back in August 26, 2023. So I would appreciate if you read it as well. If you understand everything here, then there is no reason for you to go read it, and that is perfectly okay. I don't know what this chart picture is. I haven't seen this in a minute. Oh, this is beautiful. This explains everything. Yeah, I mean, calls, you think it's going to go up. Puts, you think it's going to go down. This interface looks a bit complicated. I think it's this Thinkorswim. You have your strike price. The strike price will be the numbers you see on the right side here. The underlying asset. They make it sound so smart, right? But for the regular person, this is just the name of the stock, right? This is just SPY. Right now we're looking at AMD. Expiration date, I buy the closest one. So if I'm trading SPY, I'll buy 0 till expiration. If I'm trading AMD right now, I have till Friday. That's the close expiration I'll be buying. But yeah, that's all there is to this video.